Hi everyone, Stats Trader is here, and in this video I'm going to talk about how to trade in a volatile market. Summertime is a very slow market. There's really no patterns, no movements. There's stocks that are really not doing anything, and this is not the best place for you to trade in the market. However, fast market always starts with a supernova. Now, what is a supernova? Now, speaking the NASA language, the supernova is an explosion of a huge star. So you have a massive star that is a million times bigger than the Earth, and it explodes. And while it explodes, it releases massive shock waves of energy, and these shock waves of energy create new stars. And that's how you have stars. In the stock market, it's pretty much the same. After a period of time, let's say 2, 3 weeks, 4 weeks, sometimes a few months, you usually have a supernova stock, a stock that goes anywhere from 200 to 800% in under one day. After you have this big runner, this stock attracts a lot of people into the market again, and next few weeks you have what's called sympathy plays. Sympathy plays, they're usually stocks from the same sector or the same industry. They attract a lot of buyers because people think, okay, so a stock from this sector went up, so stock from the same sector gonna also go up. You buy these stocks, and that's how you get the volatility back. The beginning of this volatile season usually is the most dangerous season to play, and the most dangerous time to buy or sell your stocks. That leads us to 5 common mistakes that people make during this volatile market. First, and the most dangerous mistake, and the most common one, is overtrading. Now, let's suppose you have a few patterns that you follow, and then you see other stocks running up, and you see that some stocks go up 300, 400, 800% in one day, and you decide to short it or buy it, but this runner doesn't really fit your criteria, it doesn't really fit your pattern, and you end up trading, and most of the time you take a loss because, again, no statistics, no data, there's really no pattern, no nothing. Just basically become one of the part of the herd who are hyping these stocks. Overtrading is one of the biggest reasons why people crash in these volatile markets. Second mistake, if you're on a short side, which me personally it's like 95% of the time, you look at a stock that went up 100, 200, 300%, whatever, and you're thinking to yourself, okay, this stock can't go up anymore. And this is the second mistake, because it makes you short the stock thinking it's gonna drop, and most of the time it's never the case. The stock keeps going up. The second problem, not sticking with your plan, just trading these hyped stocks. Now the mistake number 3. Now mistake number 3 is absolutely the most dangerous. This mistake has destroyed a lot of traders, and people just lose all of their money in the market. And this mistake is not cutting your losses fast. And I just can't stress enough how important it is. And I know there's a lot of people who are saying, oh, you don't lose money until you sell. Well, this is fundamentally wrong thinking. You know, you lose money when you're back holding stocks that you're not supposed to be holding, or you're shorting a stock that you're not supposed to be shorting, and you're holding them overnight, collecting all kinds of fees, and eventually not cutting losses will destroy your account. Mistake number 4 is something I'm personally guilty of a lot of times, is going huge volume in the beginning of the volatile market. Now, volume has to be adjusted depending on that stocks are creating, the float of a company, the market cap and stuff like that. The problem is you can't really adjust to the market conditions right away. That's why in the beginning of this volatile market to trade less volume. If you short sell a stock, or you bought a stock and you go in full volume all at once right in the beginning of the volatile market, this is the recipe for disaster. Why? Because all your averages, or the range that a stock can create, are completely off. They do not follow the statistics, and they don't follow common sense at all, because people just see these hype stocks, they want to jump in, and they cause these massive squeezes, especially on low float stocks. Mistake number 5, which is also can be deadly if you're trading small cap stocks and low float stocks, is keeping or holding positions overnight. Now, why can it be deadly? Well, let's say a stock went up 500-700% in one day, and most of these stocks that go up this much, they usually low float, they're garbage companies. Nobody should ever buy these stocks at all, because fundamentally stocks have really bad fundamentals just in general, and they crash really fast because of low float, meaning low supply of a stock. And what happens is next morning or a few hours before the open of the next day, a company announces a offering. So what is an offering? So let's say a float of a stock or shares outstanding are 3 million. The company issues another 2 or 3 million shares on the market, and they sell them at the market price. So think about it this way: what does it do to supply? It increases supply twofolds, and now price drops another 70-80%. This absolutely ruins all your stock investments. I never advise anyone to hold. If you're an active trader, I would never advise anyone to hold your positions overnight, either long or short, because it's extremely dangerous. Or if you're holding overnight, make sure you decrease your size significantly, maybe leave like 10-15% of your normal size, but no more than that, because trust me, it can be deadly. Overall, low float stocks are extremely easy manipulated by market makers, by big players. And why is it this way? Well, again, because of low supply of these stocks. Whenever you have big volume that is little over than the average, this can basically squeeze your stock up a few 100%, or it can completely bury the stock. If this happens, this will absolutely crush your stock investment. Either you're going short or long. If you do decide to short these low float runners that went up 200-300%, I'm just gonna show you how I do it and what's the safe way to do it and how to profit from it. Okay, so this is the runner that happened today. The stock ticker is RGC. As you can see, stock went from $6 all the way up to almost $27. There's a nice percentage gain right there. So normally I would short this kind of stuff. If a stock overextend too much, I would short it, but I didn't this time, and I just wanted to explain the logic behind why is it so dangerous to short into these kind of stocks. So first of all, whenever you see a stock going parabolic from $6 to 20, 30, 40, 50, 70, whatever, first thing you go and you look for this stock and what we're really interested in. So I put this ticker, and I want to see the shares outstanding, and I want to see the float. So public float is how many shares are actually available to buy or sell on the open market right now. So as you can see, this stock is 2 million float, which is extremely low, which for me, in my mind, I know that these kind of low float stocks, they're very easy manipulated by market makers, by big players. And now think what happened here. So the stock wasn't doing really anything from 9:30 all the way to 11:30, which is really weird, because if stock has growing potential, it should spike the first few hours. That's when the most amount of volume comes in the market, in the stocks. And it didn't really do anything in the first few hours, and then of course closer towards the lunchtime you have this spike. And imagine you're a trader, you come back and you see this massive 100% spike. So what do you want to do? You want to short it, but you didn't check that it was a low float, so you short it here, and then it drops, of course. And then market makers and big players, they know that most people short it here. So what do they want to do? They want to squeeze them, because if you short here, you're probably gonna set your stop loss behind this high, and they want to take you out. they want to, if you set your stop loss here, then when you cover, you'll be obligated to buy these shares back because you're betting on the stock to go down. So this is exactly what happens. They don't really need a lot of money to make this squeeze happen, and that's why you have this second spike. So all these people who shorted here, they get squeezed, and that's how you get this massive second spike. And this is when I usually enter, after the second spike, and it drops and I get like 15-20%, and this is safe to do so. But why didn't I do it today? Well, very good question. Now let's just look at the time. So this happened at 13:30, so roughly 2 hours, an hour and a half before market close. So if this happened, if two spikes happened in the morning, let's say from 9:30 till 11, and so I have two spikes, so one here, I would definitely shorted it, right? But here, first of all, there's only 1 hour and a half left till market close, and no way in hell I'm gonna let my shares, let my short position run over a weekend, because basically your borrow fees are multiplied 3 or 4 times, and you pay this rate on a daily basis. So if my borrow fees for this particular stock were $50, which they were, for let's say 100 shares, $100 times 3, that's $150 that you're paying every single day. So $150 times 3, because it's 3 nights or 2 nights, that's $300 that you have to pay just to keep this short overnight. And I don't want to do that. That's why I skipped it, and I'm very glad that I did, because it wouldn't have paid for all the fees to even enter the trade if I decided to let it run down. So if it happened 11 a.m. New York time, I would have shorted it. It didn't happen, so I didn't. So yeah, skip this trade. But let's see, there's another ticker that happened just a few days ago, and it's PMCB. And if you can see, it's actually the same scenario. So this stock happened just a few days ago. The same thing, it was a runner, morning runner. So it spiked from $6 all the way to $10, and as you can see, normally I would short this kind of spike, but I didn't because of how much volume the stock was trading. And people, market makers, whenever they see this huge red candle, they know that there's going to be a lot of short sellers, right? And they'll try to squeeze you out of the position, and this is exactly what happened. So I was trading this stock, and I was shorting it here, just small volume, like 1/3, 1/4 of volume, and then my main volume comes here, and then the stock drops. So, and that's why, when you want to short the stock right now in a crazy market, when there's a lot of volume, I would suggest not shorting the first spike. I would suggest waiting for the second spike, and then if you want to short the stock, you can short it. So yeah, market is back, volume is back. There are solid opportunities to make money every single day. So just stay safe with your positions, with your risk management. Most importantly, track your data and set your stop losses. And thank you guys for watching this video. If you guys have any questions, you can ask them in the comments below under this video. Also, I do one-on-one sessions where I teach 7 strategies, and I teach you how to track statistics in Excel for these strategies. Also, I'll give you the averages, and this is really the best time to learn right now, because market is heating up, and we'll be having a strong market September, October, all the way till the end of the year, and it's better to be prepared and actually make money in this market. Alright, thank you guys for watching, and see you guys next time.